what we're going to be looking at here is an intangible asset, and we're specifically going to be looking at an internally created patent here, or a company developed their own patent here, and it's related to technology. And for example here, Corporation A during 20X1 spent $340,000 in research and development costs here to develop a new product, which resulted in a patent that was granted here on October 1st here of 20X1. Now the legal life on patents is 20 years, but in our example here we're going to start out with a useful life on this patent here of 10 years. And the legal costs regarding the filing for this patent here, developing a patent up until 10/1/20X1 was $48,000. Now on June 1st here, 2 years later in 20X3, they spent another $24,800 here in legal costs to successfully defend the patent on an infringement suit here. Somebody was trying to use the patent and they have to go and they successfully defended in court here for the use of this patent here. And the useful life at that time was extended to 12 years because of this suit here. And during 20X5, 2 years later here, they determined that the patent would be obsolete and worthless here by the end of the 20X6 here. 2 years later, 12/31/20X6, they determined that the patent would be useless or worthless here. So first thing we have to do here is we have to understand the accounting treatment for these intangible assets, and we're specifically again looking at the patent here, and you have two types of intangible here. You either have the, well, as far as a life is concerned, you have either a limited life intangible or an indefinite life intangible, and in our case we're going to be looking at the limited life case here. And you could either have purchased this patent here, or you could, in our case, we're going to be looking at the internally created or developed patent here. And if it was purchased here, you would be capitalizing it at the purchase cost here. But for an internally developed patent, we would be expensing everything here, except for direct costs. Now, those, what are we talking about? Direct costs would be attorney's fees, registration fees, consulting fees, and successful legal defense cost here in the patents. And that's what we're going to be looking at, our successful legal defense costs. We'll use it in this example. The other thing is amortization here of the patent. Now, with a limited life, you would amortize it here for its useful life. And we're going to be looking at that here. We're going to have a change in useful life. And then one other thing here, you could have an impairment testing, and we're not going to be looking at that here. We're not going to have any impairment here on it. Okay, so further to expand on our intangible assets and looking at the technology related ones here, they relate to innovations or technological advances and trade secrets. So let's just go look at our points here. Patents are protected for a period of 20 years, either as a product patent, which covers the physical product here, or a process patent, which covers the process of making the products. Number two, if the company buys a patent, it capitalizes it at its cost. Well, we're in our example here, we're going to be internally developed. Now, three here, you can capitalize other costs for securing the patent, legal costs to secure and protect the patent, and we're going to be looking at what we have to capitalize there in our example here. And number four, you must expense as incurred any R&D or research and development costs related to the development here of this patent. And those are expensed here. They're not capitalized, they're expensed as they're incurred. So next we'll look at how we'd record this on our balance sheet and income statement, and how we'd amortize this patent. Okay, now let's look at how we'd record this patent on our balance sheet and on our income statement. Remember, this is an internally developed patent here by the company here. Now, what we would do here with these R&D costs, they would be expensed here as they're incurred. You do not capitalize them for the patent here. They'd be expensed out here. So just looking at our research and development costs here, starting with our cash account here on our balance sheet, let's just say we had credited our cash here for $340,000. Remember, that was the initial cost here, R&D costs on this patent, and we would recognize it on our income statement here as R&D expense here, and we would have debited that here for $340,000. So the next thing we have to be concerned with is how we capitalize this patent. Now remember, it was only the legal costs that were capitalized in this case. So what we had here for on our 10/1/20X1, remember we had that first legal cost here for filing for the patent here, development of the patent here of $48,000, and then later here in 20X3, June 1st here at 20X3, we had another legal expense here to defend this patent here, a successful defense of this patent on an patent infringement case here, and that cost us $24,800. So both of those amounts here get capitalized on our patent account here on our balance sheet. So the next thing we have to be concerned with is the accumulated amortization on this patent that we developed internally. So this is what we're going to have to look at here, and how we calculate our amortization. And then once we calculate our amortization here, we would credit that our accumulated amortization account here and debit here as patent expense here on our income statement for the respective amounts here. Remember, the accumulated amortization, that's a contra asset to the patent account. Okay, or our asset account here. So let's go and look at how we'd amortize this. So for our amortization calculation, so I'm going to just show our capital balance here, or what our capitalized amount is here, and then we'll just calculate it out here for each of the periods here. So starting with our October 1st period here at 20x1, we have a capital amount here. Remember, the legal cost here was $48,000 for the patent, and then we had that was as of 10/1 here, so we have 3 months remaining in the year here, October, November, December, and again we have a useful life here that we estimated at 10 years here. So for our 3 months remaining in our remaining in the year here for 20x1, you just take the capitalized amount that we had here, 48,000, divided by 10-year life times 3/12 here for the year. So you're going to get an amortization expense here for 20x1 of $1,200. Now for 20x2, we can just go on and we just look at a full year's amortization. The capital amount here, 48,000, divided by a 10-year life, that's $4,800 capital, our amortization expense here for the year. Now, this is where we're going to get into, we're going to have some legal costs here to defend the patent here on 6/1 20x3, and this is what we're going to have to look at. So up until that date here, we can still use our capitalized amount here that we have, an initial amount here, $48,000, divided by a 10-year life here, and then we're going to take it for that portion of the year here from January 1st through June 1st here at 20x3. That represents 5 months, so 5/12 of that, our 48,000 divided by 10 years, is going to give us a amortization expense here for that first 5 months here of $2,000. Now this is where we have to recalculate our balance here because we're going to have a change in our life here, on our useful life here on this patent, plus we're going to have this additional expense here. So let's just go look at that. Our legal costs to defend the patent here on 6/1 20x3 were $24,800. So that we had to capitalize here. Now we have to calculate what our amortization expense here would be from 6/1 up through the end of the year here for 20x3, and then that would be 7 months. So what we have to do is we have to come up with this balance here. So what we do is we just net our amounts here. So we start out with 48,000. We had these expenses here for each of those periods. Then we added another capitalized amount, another amount here, 24,800. So our net amount here, netting all our expenses out with our new additional capitalized amount, we're going to come up with a balance here of $64,800. So now we can figure out the amount of amortization here from June 1st through 12/31 here for 20x3. So we just take that balance here in our net capital amount here at $64,800 dollars here, divided by the new useful life here at 12 years here, and take that times the 7 months of the year here, remaining 7/12 of a year. So we're going to come up with an amortization expense here based on this new balance here for the that portion of the year here, $3,150. Okay, so now for 20x4, well, we got a full year's amortization there, so we would just simply take our balance here, $64,800 here, divided by the 12-year life, and we're going to come up with an amortization expense here for 20x4 of $5,400. Now, this is where we came up with, for 20x5 here, we had also a change in life. During 20x5, it was determined that the patent would be worthless here in 2 years here. So we're going to have 2 years useful life remaining here. So what we would do here is we have to come up with our new balance here. So what we've done here, we just start out with our 64.8, and we'd be subtracting out the amortization for those periods from that amount here for those 2 periods, and we got up with our balance here, $56,250. So for 20x5 and 20x6, our amortization expense, remember we only have 2 years remaining here. Our balance is $56,250 divided by 2 years here. So we're going to come up with an amortization expense for each of those 2 years here, $28,125. Okay, so what we had to do is we had to, in 12/31/20x6, the patent was worthless. We had to amortize it down here to 0. So remember here we had that was our balance here for 20 at the end of 20x4 here, 56,250. Subtracting those two amounts, we come up with our balance here of 0 here. Our capital balance here is 0. That we've amortized it down to what it was worth here, 0 at that pen. Okay, so let's just go back over here and look at our journal entries again here. So for this patent here, remember we had those amounts here were capitalized, so our accumulated amortization for this patent development here we have shown here for each of those periods that we calculated. So we would have credited our amortization account for that amount here on our balance sheet, and then we would recognize it as again here as patent expense here on our income statement for the patent amortization. So that's how we recognize, how we amortize this patent down here. And just one other point here that we want to make. So remember, for we capitalized, we only had a few things we could capitalize here, and that was those legal costs, and there were some other costs as well, but in this case it was just those legal costs here that we capitalized on the patent. And then remember the R&D costs here to develop the product here that was patented, those are not capitalized. Those are simply recognized here as expenses here, R&D expenses here on our income statement. So that takes care of our internally developed patent here and how we'd amortize it. And you notice we had a number of changes here due to the change in the life here of the patent.